Welcome to Growwcast, your go-to podcast for business, finance, immigration. I'm your host Sachin Mandot. I live here in Canada and try to explore as many topics around Canada or expat life or non-resident Indians as possible. Today I have Adittya Singhal with me. Aditya is an Indian chartered accountant and a CPA from Canada. He has 10 plus years of experience in accounting and is a cross-border taxation expert. So I've been seeing a trend of a lot of people who are looking to move outside Canada, and we have been seeing news reports as well. Moving outside Canada, immigration has hit a 10-year high right now. So I am going to speak to Aditya a lot on the taxes that a person has to pay or things that a person has to do while they go out. Welcome, Aditya, to the podcast.
Hi, Sachin. Thank you so much for inviting me for this podcast. I'll try to provide as much answers as I can.
Yeah. So
Thank you.
Aditya, are you seeing a lot of people reaching out to you for getting this departure taxation done now?
Yeah. So as we were chatting last week as well, right? So a lot of people, a lot of people are moving to states as well because they're
Yeah.
getting contracts in different parts of the world. So we do get a lot of requests, specifically people who are moving to US and get the compliances and whatever the questions related to it, and obviously with respect to reverse immigration, so people who are moving back, they have certain investments here or a property here, and they want to close their files in Canada and do all the compliance. So yeah, we are getting a lot of like kind of requests from people how we should approach this, how we gonna withdraw money from our corporation accounts, how we gonna manage our RRSPs and TFSAs. So yeah, all kind of people are approaching.
So Aditya, first question that comes to my mind is, and there's a lot of gray area around it. Does Canada have a departure tax?
Yes, so that's a very good question. So Canada has a rule which is considered as deemed disposition. So what that rule says is, once you are leaving Canada and you become a non-resident of Canada, it is deemed that you are selling your assets, and
Okay.
tax, the capital gain tax is applicable on that portion of it. But there are certain assets which are excluded from this departure tax provision as well. So let's say if you own a house property, anyhow, like property located in Canada, it is not within the ambit of departure tax rules. So you don't have to pay departure tax on this.
Okay.
Whereas if you have shares, or you have investment in stocks, and at the time of departure, whatever the fair market value on the date of departure would be considered as a sale value, and whatever the difference, you have to pay capital gains tax on it, though you have not realized that gain yet.
Okay, so the
That
tax
is
is
a
a notional gain. I'm not selling my asset. I'm not selling my stocks.
yeah,
But as soon as become a non-resident,
yeah.
CRA considers me to have sold those assets and
Yes.
tax on it.
Yeah, obviously there are certain more nuances related to the law itself, like how much time you spend in Canada. But the logic behind this rule is like Canada is saying how much, whatever gain you have on while you were in Canada, just pay tax on it and leave it. And at the same time, let's say if you sell it after 2 years, so then your cost of acquisition would also get adjusted, right? So because you've already
It was
paid.
indexed on the day I left. It
Yes.
would be indexed on the day my departure tax was paid then, and only
Yes.
that gain would be taxed later.
Yeah. Perfect. So let's just to give a quick example. So let's say you bought a share for $100 and fair market value on the date of departure is $150. And let's say you sell it after 2 years, right? So after 2 years, it's for $200. So you just have to pay gain on $50 at the time of departure, and then obviously remaining so 200 minus $150, that would be the gain on the to pay tax at the later stage
So this
if
is
you have to
actually
pay
good
tax.
information because not a lot of people know this. What they know is Canada has taxed you, and then you might have to pay all the taxes again. But that's not the case. You fairly pay your taxes on the indexation, as per what you explained.
Yes. Even if you are not a resident of Canada, then you may not end up paying more tax here, right? But then at that point in time, there are provisions like Canada has a lot of double taxation avoidance agreement, right?
Yeah. So,
Yeah.
how does CRA determines residency of a person who has left Canada?
Okay. So first, in order to answer that question, the easiest way is to first see how the residency in Canada is determined, right?
Okay.
So it is on clearly two aspects. So one is you have a primary ties with Canada or not, and once you don't pass the primary ties, then you look at the secondary ties in Canada. So when I look at the primary ties, I just have to see three things: whether I have a home in Canada or not. It doesn't mean that you own the property. Even if you're renting, you have a rental lease or a co-share agreement, that is also considered that you have a house in Canada. Then where is your spouse? And then the third one is where are your dependents or dependent? So if
Okay.
any of these ties you have with Canada, then you are considered as a resident of Canada. In case you don't pass these tests, like your family is also moving with you, you are also moving out along with your family, and you were renting a place and you're letting it go, or you owned a place and you're renting it out, right? Then you move to the secondary ties. So you might have heard that when they determine residency, this they look at the secondary ties. So let's say if my job is here, I have all those like social economic ties here, I have my driver license still up and running, I've not informed everyone, like all my economic and social ties are still with Canada, and my intention is not I'll never come back to Canada, like all those aspects. There are a lot of things which we need to consider at the time of determining the residency. So if that also falls, then you may also be considered as a resident of Canada. So best way is to reach out to CRA, fill up a form. It's a NR73 form. It's available on Canada Revenue Agency website, or you can Google it as well, and then they can determine your residence. If you have any question, it has a detailed list of questions: how many days, what are your intentions, and all those things, like very basic question. You can do that, but obviously you have to consider the timelines of the response as well, because CRA does take their own time to respond. Or you can take help with a professional who has some guidance around it, and then based on each aspect you can determine your residency for that particular year.
So, there are question on this. So, let's say if I decide to become a non-resident, uh,
Yeah.
do I? So when I became a resident, I had to mark that when did I become a resident. I
Yes.
put in a form.
Yeah.
So when you become a non-resident, what do you do?
Yeah, so there are certain things. So first of all, as soon as you start planning to leave Canada, you've decided, okay, I've booked my tickets, I'm leaving this day for permanently, right? So then first thing is, do inform your banks, and with respect to CRA, you are not obliged to call them and let them know, but it always better either you call them, or the only from the requirement perspective, you have to report it at the time of your filing of tax return for that year. So let's say when you'll file your T1 in the following year, like, and at that play time there is a column which says, okay, date of departure, and then there are a couple of associated forms which you also need to fill, which is known as IMM forms, where you'll give all the details, okay, where you have moved, how much income you've earned there, so that your non-refundable credits and all other credits gets calculated properly. So there is no
Okay.
obligation at your end, unless and until you want to have certain benefits of being a non-resident. And also, like, if you're receiving a lot of benefits from CRA, let's say childcare benefit or incentive allowances and other kind of like carbon rebates, right? So it's always better to let CRA know, because your payment won't stop until CRA would get to know that you're non-resident,
Yeah.
right? And in that situation, I've seen like a lot of people are getting notices because they became non-resident. They were still receiving the payments, and now CRA has sent the letter to collect those payments back. So
And
that's
they
why
collect it with interest or without interest? Do they collect
no,
it with penalty and interest?
no. So they don't charge penalty and interest unless and until I don't want to comment on it because I don't get to see the details of it.
Yeah.
But But yeah, they
It's a
may
CRA
charge.
thing.
Yeah, and they may charge from the date. So let's say if you are not in Canada, right? So let's say if you
Yeah.
don't receive that letter, you like you don't have the same address, or if your email address registered you didn't receive on that. And if there are a lot of people who doesn't register their email address with CRA, right, who are still on mail, right? So it's always better to either to consult or just let CRA know as soon as you are leaving, if you are receiving monthly payments or quarterly payments from them. If you're not eligible and you just have like no other payments coming from CRA, then it's okay. You just wait until you file your taxes, and at the time of filing your tax return, just let your consultant know, or if you're filing on your own, put that date of immigration, so that all the benefits which you're receiving will get prorated for that year.
Okay. So now I will come to different asset classes or different type of accounts that I hold or people hold, and what happens after becoming a non-resident. And I'm
Sure.
leaving out house from this because I think house demands a separate episode in itself. House and
Uh,
rental income is a separate episode.
yeah. Yes. So with obviously with house, it's like different sets of income, whether you are earning rental income, or it's just a sale of your house, or is it a sale of your investment property in Canada. So each has their own nuances, right? So yeah, we can talk about it later for sure.
Yeah.
But if you have any specific thing in mind which you want me to put add in my comments, then definitely you can ask that as well.
So I'll let our viewers ask this question and then we'll shoot that episode. And please let us know what are
Sure.
your questions on housing and rental income after becoming a non-resident, and Aditya will answer your questions on that.
For sure. For
But
sure.
the first is RRSP. It's an account that most of us who have been employed in Canada hold. Either their employers contribute to it, or either they contribute to save the taxes or sheltering their incomes. So, what happens to
Yes.
RRSP after I become a non-resident?
Okay. Yeah, that's a very good question. There are tons of articles, tons of information on this particular
And
question.
misinformation as well.
Yes. Lot of misinformation around this. So first of all, you have to understand that whatever amount you are investing in RRSP account is your pre-tax money. You have not paid tax on that amount to Canadian Revenue Agency, right? So let's say if you become a non-resident of Canada and you don't touch your money until the age of retirement, it's okay. You can keep it.
Okay.
Whatever earnings you'll have within those investments, it will keep growing. It is tax deferred. No tax has to be paid in Canada. In Canada. Okay. The next thing is, okay, what will happen if I withdraw it? At the time of withdrawal, taxes are applied. Even if you live in Canada or you leave, if you left Canada and you are become a non-resident of Canada, taxes would apply at the time of withdrawal from RRSP account before the age of retirement. So
Okay.
that would depend. So there is a standard rule that Canada says, okay, we'll charge 25% withholding rate. So of whichever bank or investment company you have your RRSP account with, they'll clearly withdraw 25% of it, and then they'll pay to CRA. You don't have to file any tax return. No other compliance is required from the individual itself.
Okay.
However, if you want to claim treaty benefit, so what is treaty benefit? So Canada has double taxation avoidance agreement with more than 100 countries in the world. So US is one of them, India is also one of them. So then you can claim some treaty benefits. So what that double taxation avoidance agreement give is like for certain kind of income, preferential rate of withholding would apply. Because so let's say for US, right? So it's like 15% withholding rate instead of 25% withholding rate. So you can submit some documents to your bank. So there are certain forms in our 30 form one, along with some documents which bank will request you to submit to show, okay, you are resident of US now, and then you can claim, and then bank will just deduct 15% out of your withdrawal income. So that is now okay. So let's say taxes have been withheld, right? Now it's your chance. your turn to file your taxes and disclose that income in Canada. If you are getting it deducted at 25%, you don't have to do anything. You are good. But what about the country you are living right now, right? So let's say if you move to states, just to give a quick example. So if you move to states, US does not consider RRSP as a tax deferral account or a tax-free saving account. Like they don't know about it, right? So they might consider those as your regular investments or not. Similarly with India. So it depends which country you are moving. First of all, that is very, very important. How they treat income within RRSP, how they treat withdrawals from RRSP, how they're gonna tax it withdrawals from RRSP. So all those three questions should be clear in your mind because that will change a lot of tax amounts and applicability of tax on the RRSP withdrawal. So if
So
you, yeah,
basically, in order to withdraw RRSP tax free, one has to move to a tax free regime, like maybe Singapore or lower tax regime, Singapore, Hong Kong, or Dubai, or Saudi for that matter.
no, yeah, you can say that, but in that case, you're gonna pay at least 25% in Canada
25% is minimum. Yeah.
minimum, right? But however, let's say if you move to any country where tax rate is like your average tax rate for the year, because each country has their own financial year, own income tax slab rates, right? So let's say that's why like a lot of planning comes into picture when it comes to RRSP withdrawal, right? So either you phase out your withdrawals during the period of your like let's say instead of withdrawing it right away, I'm gonna phase out the withdrawals. A lot of people like one of the way which a lot of people recommend, and like in case of high value of RRSPs, it's better to have it in RRIFs and then get it like monthly payments and like quarterly payments instead of getting everything at one go, so that you can manage your tax liabilities. The other way is a lot of people like wait until the certain age to withdraw the money, so that like if they can expect at certain age their income would be this, and in that year it would be better. And one thing as well. So let's say a lot of people who are moving to like if people are moving to India follows a financial year, right?
Yeah.
So sometimes planning can also play a key role. So
So some portion in this in March and some portion in April to split it into two financial
yes.
years.
And
Wow.
let's say the year you are moving into India, and if you are non-resident of India for that year, then you can also plan things around those. So that's how you can manage your RRSP withdrawals as well. Yeah, and it's always better to think through before you move from Canada, because things
Okay.
might change, because a lot of things, right? Like because you cease residency in Canada, now you have okay, at the time of it all there are gonna be a withholding tax. But if you withdraw that before becoming a non-resident of Canada, there won't be withholding tax will not get withheld. Right now you have an opportunity, now you have to pay, right? And then you can plan, okay, I'll pay this much here, and obviously whatever the applicable rate in Canada you have to pay.
So in a year, when you're moving out and you do not have an income, it's always beneficial to take it out while you are a resident and not as a non-resident.
Yeah, so there are a lot of tax calculators available on Simple, or obviously you can take help of anyone, and just try to calculate your average rate of tax for the year. What would be your applicable tax rate, right? And based on that, you can determine, okay, so if I withdraw this much amount, what would be my taxability on that amount, and that's how you plan things better, right? So yeah,
And what happens to the second account that everyone holds is the TFSA account, tax-free saving account.
yeah,
Because people use it to, for people who are here for short term, they use it
mm,
to hold GICs. People
yes,
who are here for long term, they hold it to use S&P 500 or TSX. So
yeah.
what happens to that?
So
Do I need to withdraw before moving or after moving?
So with respect to TFSA, so the same thing, but you are putting your post-tax money into tax-free savings account, right?
Yeah.
So it does not matter whenever you want to withdraw it, withdraw it. It does not matter from tax perspective in Canada. However, here you have to be more cautious about your tax liability in your other country. So let's say US, and even US has states, right? So state may have different tax implications for holding a tax-free account outside of US.
Yeah.
So if I see from the US lens, they see this TFSA account as a foreign investment account.
Okay.
So there may be an obligation for you to report certain forms to disclose all the income within TFSA that might be taxable in states. It is
And they
not
have something called
taxable.
as PFIC rule, right? US is very complicated when it comes to foreign investment.
Yes. So that is called like passive foreign income class. So those PFIC accounts, so TFSA might qualify as PFIC as well. So there's 8621 forms filing. Along with that, you have to file if the investment is more than $10,000. It's you have to form FinCEN form as well. If at any point in time your balance is more than $25,000, there's 8938 form applicability as well. And those forms need a lot of information, like your account type, name of the bank, and all those information you have to fit in. And obviously whatever income you're earning within your TFSA is also getting taxable there, right? And because you're not paying tax on that income here, you don't have any credits to claim in US, so you end up paying US taxes on that income which you are having in TFSA.
So isn't it
So
better to
that's
withdraw if I'm a resident of Canada because I'm not going to pay taxes on it anyways? It's a tax-free withdrawal.
yes,
So
yes,
so
yes.
why
So
to take headache of getting it taxed in a different country?
yes, yeah. So that is a thing, right? So you have to check which part of the which part of the world you're moving in, right?
Moving.
So there may be certain countries. Like I can't remind it on top of my head.
It's
Like this
okay.
country still considered TFSA as a tax-free account, but yeah, generally this is one of the recommendation. But obviously like it's everyone's own call on this. But yeah, most of the people are advised to withdraw money from their TFSA, close it, and then have a separate investment account if they want to keep investing in Canadian market. If they are planning to leave Canada, there are a lot of situations such in like people leave in a hush and then they come back as well. So like it's world economy, right? And sometimes
Yeah.
like people go to states to they get the better opportunity, or their company wants them to move out of company wants their people to move and work in states, but then they don't like there, so they want to come back. So you and they might get a 1 year assignment and decide, okay, what you want to do, whether you want to stay in US or come back. So those kind of situations, and then you don't want to let go everything. However, very good part is, so let's say if you withdraw your money from TFSA, your contribution room will be there for
Okay.
whatever years you were resident of Canada. So right, like with TFSA, just to give a brief, so you get a contribution room for each year, right? So let's say if you get a contribution room of 6,000 in your year of arrival, and you don't contribute anything, like invest anything in TFSA, it will carry forward to the next year. So next year you have 6,000 for that year and 6,000 for the prior year. So you have 12,000, and it keeps growing,
Okay.
right? That's how your like contribution room grows. So it will stay intact for the years you were not a resident of Canada. The moment you become a non-resident of Canada, it will stop there. And let's say if you come back, your room is still there, so you can come back and start investing again.
That's actually very good information. People who use it as a revolving door, who
Yeah,
can go to US, come back, they can use this particular limit uh,
yeah,
to start making investments again. I'm assuming that obviously whatever you have said for the non-registered investments, which is like my regular stock or regular GICs,
yeah,
they are going to have 25% withholding if I withdraw after becoming a non-resident. They will be
yes,
treated at par of all of that.
yeah, for sure. And obviously, those accounts have the set of compliance requirements at the time of departure. So either you may end up filing T1243, which is like deemed disposition sales, and then there are if like there are certain limit, like let's say $25,000 or more, then 1161 form as well required, and then obviously the other country might have different tax treatment for the gains you're getting or the interest income you're receiving. But obviously, you can take help of double taxation avoidance agreement as well to see how much which income sources would be considered as like part of those ambit, right? Like are part of those
Okay.
treaty or getting any preferential treatment or not.
Okay. So I think Aditya, that brings me to the end of my questions, at least for the registered and non-registered accounts. Thank you so much. And is there one tip that you want to give to our followers who have listened to you on this? Like one small tip when they decide to become a non-resident. What is the
And
most
the
important thing that they should do?
yeah the most important thing is to summarize on a paper, literally on a sheet of paper, all your investments in Canada and outside Canada, and then plan your date of departure. To plan your date of departure, if you have an opportunity to plan it, always better to determine your residency in the host country wherever you're going, and determine your residency for that calendar year, financial year in Canada. Once you do that, a lot of things will get sorted. And then definitely, if you own a property in Canada, it's always better to do it as soon as possible, because rental income has different compliance, capital gain has different compliance, principal residence exemption will stop. So there are a lot of nuances related to it as well. Yeah,
Okay. Thank you so much, Aditya.
it was
I'm
pleasure
going to
to.
put I'm going to put Aditya's contact information in the description. If any one of you has a question, wants to get more deeper professional assessment with Aditya, you can reach out to him directly.
For sure. Thank you so much, Sachin. It was pleasure to connect with you, and hopefully we'll catch up soon on other topics as well.
Yeah, on the housing. Yeah, I'm waiting for questions from people.
For sure. Thank you. Have a good rest of the day.